back, everybody. We're going to talk about the opportunities and consequences of U.S. and European economic and monetary policies. And joining us on the panel today, Justin Du, who is the Senior Managing Director at Welton Investment Corporation, Dr. Amer Bisat, the Partner Portfolio Manager at Traxis, and Nicholas Colas, who is Chief Market Strategist at ConvergEx Group. Welcome to all of you. Glad for you to be here today. Let me just start. We've seen record low interest rates in both Europe and the U.S. and additional quantitative easing. What do you see as the impact of these policies on the stock market, on commodity prices? Who wants to take it first? Go ahead.
So, yeah, I think that's the right way to think about the question, because there's so many different threads in this discussion as far as what these really abnormally low interest rates have done, what quantitative easing has done, and you have to follow, I think, three distinct threads: the economy, whether it be the U.S., Europe, or the rest of the world, the stock markets, and sort of all other. And I'd say from an economic standpoint, it has been a mixed result. It has certainly benefited asset prices and should continue to benefit asset prices. But I think you can point to the U.S. labor markets as one area where these very low interest rates have yet to really spark any kind of meaningful recovery. And we're still so far away from the normal trajectory of an increasing level of employment relative to virtually any other recovery since the end of World War II, that I think you'd have to put at best an incomplete and at worst an F next to that factor when it comes to interest rates and the U.S. economy. You know, just to give you one soundbite, I track something fairly abnormal. I track people on food stamps in this country. And there's 308 million Americans, and there's 43 million people on food stamps. It is well north of 12, 13% of the entire U.S. population. And that number's gone from 25 to 43 million over the course of the past 2.5 years. So by that measurement, I don't think we can rank the abnormally low interest rate policies that we've had as any kind of material success. At best case, it probably forestalled a much worse both political and economic crisis. So I'd say it's more of a fire hose to put out a fire, which isn't really out yet, rather than any kind of actually palliative effort to improve the economy. I think best case, we avoided a bigger crisis. And at worst case, we're creating bubbles in everything from the commodity sector to the financial asset sector, and that continues. It's very good for stock prices, it's very good for gold prices, it's very good for a lot of different assets. It has yet to really prove itself as a meaningful improvement in the economy.
Just, I would just add that, well, we're a quant shop, and so we think about things a little bit differently, and I'm certainly a quant kind of guy, but perhaps without the credentials. You know, what we've seen certainly is a lot of kind of outflow from this activity. You know, in terms of the dollar movement, in terms of interest rates globally. A lot of discussion was had earlier about commodities and EM, and certainly there's been a lot of kind of, again, asset flows globally from the dollar and from energy more recently into those various markets, and certainly there's a lot of opportunity for folks like yourselves, I would think, to profit from those movements. But you know, I couldn't really answer the question intelligently from an economic perspective because that's not really our bailiwick. It's more an analysis of those global flows.
The beauty of these kinds of conversations is that it's nice to disagree. So allow me to disagree with you.
Absolutely.
No, I mean, you cannot divorce the discussion of quantitative easing from the size of the shock that first faced that this economy and most Anglo-Saxon countries faced. This shock was unprecedented, or at least not in the past 80 years. We've never seen anything of the sort. And it's a balance sheet problem. What happened is that you accumulated assets at a rate that was well beyond the capacity of the society to accumulate, and you funded them through massive leverage. The bubble bursting, and if we could raise questions of why this happened and could it have been avoided, that's a completely separate question, which we probably should discuss. But we had that shock, and that shock was massive. And the minute the value of the assets collapsed, you still had to fund it from somewhere. The funding had to be, I mean, so the asset value drops from 100 to 80, but liabilities don't. They remain at 80. And that forces you into kinds of insolvencies, insolvencies, bankruptcies, and illiquidities. That is what created the massive recession that we faced since late 2007 up till now. The answer to this, the orthodoxy tell you, is very straightforward. You fund the system. You provide it with the kind of liquidity that it needs so that this kind of balance sheet shock that you face doesn't create the deflationary spiral that we've seen the result of. Look at Japan. Look at many other places. There was no answer but to do it through that way. That was there's an alternative, and you need to do both, which is fiscal. You need to provide demand through fiscal because you are also getting into the spiral of deflationary threat. So liquidity easing and a fiscal propulsion is the traditional answer to this. Has it worked? I would argue almost certainly it has. Right? Industrial production in this country, the level of industrial production is back to where it was 3 years ago. I mean, that's from the depth of the crisis that we were in a few years ago. That is a remarkable achievement. Labor market has its own problems, but remember, the labor market is the other side of the coin of what the corporate sector has been doing. The corporate sector has done an enormous job in cutting costs enormously so as to provide the kind of profitability that is allowing it today to invest at the pace that it is. So there is a problem with the labor market, clearly, and it's a serious problem. We need to get out of it. But that's a counterpart to a success in the corporate sector as well. So it could have been significantly worse. That's not a statement to be dismissed, given the size of the shock that we've had. So the reaction of the asset prices in the US, let alone the impact of the asset prices elsewhere, and in the US itself, is perfectly rational to the size of the problem and the size of the solution that was given.
What investment strategies are investors using to profit from these policies? Yeah.
Okay. I think the easiest one to point to is you're still seeing money flows into financial assets. I'll give you one example, which I found tremendously striking. Up to the day before the earthquake and disaster in Japan, the EWJ, the ETF that tracks the Morgan Stanley International Japan Index, had received about $1 billion of money flows up until the day before. And the day that occurred, and a couple of days afterward, I was watching the money flows into that fund, thinking you're going to see at least half that money come back out. And it didn't. It stayed right there. And as a matter of fact, in the week since the tragedy, we've had another $1 billion of money flow into Japan. And it struck me that that is as much emblematic of the liquidity that's still in the system and the desire that investors have to continue to invest in financial assets. So that's one example. I think you can look at gold, you can look at silver. I mean, silver demand is just through the roof. Silver prices hit a new high today. Oil prices are still on an upward bend, even though everything, from an economic standpoint indicates that demand is still not as robust as that price increase would indicate. It seems to be more political and liquidity driven. So I'd say in general, people are just as maxed out long as they can possibly stand.
I would take a bit of a different approach. We think about things, again, kind of from that macro perspective, and we build our portfolios a little differently. And what we're seeing is institutions, primarily pensions, corporate publics, foundations, endowments, primarily in the US, but also internationally as well, looking at the systematic macro bucket as a potential for an allocation. And actually, currently, and I don't think this has shifted that much in the last 3 months, but perhaps in the last year and 3 months it has. Currently, the systematic macro bucket that I would suspect you would include yourself in, or your firm in anyway, is the largest hedge fund strategy basket on Earth. It's something on the order of $350 billion or something like that. So I think you'll continue to see that grow because those strategies, the discretionary macro, the systematic macro strategies, are ones that don't profit necessarily from evaluating the corporate profitability difference between one company and the next, but are looking at asset flows between, or I should say within a silo, within an asset class, or amongst asset classes, and not company specific or even commodity specific. So that's what we've been seeing.
So I have sort of two answers to this. The first is I completely agree, which is that excessive, this very loose financial policies that we've seen in the world, the first order of benefit has come to those sectors where there is a capacity constraint. You cannot increase production quickly enough given the rise in demand that is being generated by the excessive money supply. Commodities, right? This is very obvious. Food prices, properties in China. Everything which is where the excess demand cannot be increased through volume, it increases through prices. And that is essentially what you're suggesting. And I think there's a lot of merit to that. There is a speculative component to the asset prices that we've seen over the past 2 years. However, I think we're in a new paradigm right now. Not that this will not persist and will continue. We're in a new paradigm right now. New paradigm because the valuations have become so excessive and because we're 2 minutes away from the possibility of tightening of liquidity among the G7 countries. We're very close to the point where that liquidity is going to be starting to move. Instead, we're at the point where we need to be asking ourselves, which sectors have gotten into sustainable growth? Which sectors in the global economy and which countries in the global economy have gotten to the point where they don't need those financial assistance anymore, that easy money supply, sort of the easy liquidity anymore? Which ones are the ones that have gotten back onto a normal cyclical behavior? And until unfortunately the last two shocks of the Middle East and Japan, it did seem like the US was entering into that path. And that is a huge statement. And the fact that the US has gotten to the point where it appears like it had entered into the self-sustaining path, it makes the US, makes cyclicals, makes Northern Europe, unfortunately made Japan, until the earthquake, part of a group of countries where it appeared like we've finally been able to move away from the emergency world, where we were surviving only through the injection of liquidity, to a world in which we could go by ourselves. And that's the asset prices that I think from now on, if I'm right, will continue doing very
Do you expect we see an increase in inflation?
I personally don't. And this debate is live, very intelligent people on both sides. I could sort of see the reasons why people are worried about inflation. I personally think that in a world in which slack is so enormous still, in which unemployment is still as high as you suggest, you're mentioning, in which capacity in capital is still huge, in which demand is still weak because of deleveraging, I cannot see inflation being an issue.
Is there agreement here?
No, I mean, we're already seeing it, right? I mean, certainly in the commodity price space, the cost of cotton and cocoa and sugar and everything else, I mean, cotton certainly is limit up for weeks, or at times within the last few weeks, it's been nothing but up. So I actually think it's already here.
Yeah, I think it depends on where you are, geographically, physically where you are, because if you're a Chinese citizen living in China, roughly 30% of your basket of goods purchased is food. If you're in the US, that measure is 8.5%. If you're in Europe, it's 15%. And so different economies at different levels of development have different exposures to the rises of these commodity prices. So in the US, with an 8% weighting for food and 7% weighting for energy, the CPI is going to look pretty benign. If you shift that over to another country, it's going to look much worse. And if you shift it over to a lower income American, somebody making, say, the poverty line or up to 30% over the poverty line, it's going to look more like the European experience. It's going to look more like an inflationary environment. As a matter of fact, we're putting out a report tomorrow that shows if you weighted the US CPI based on what goes on, say, in the Polish CPI, which is equivalent in income to a person living at that 130% of the poverty level, you'd be experiencing roughly 4% headline inflation instead of 2% headline inflation, just from the amplified effect of fuel and energy and food on your particular basket of goods purchased. So how you view inflation depends a lot on where you sit.
But also, if I may just kind of follow up on this, it also very much depends on what part of inflation you're talking about and the sustainability of that shock. A lot of discussion is focusing on headline. It's very much focusing on not on core. And at the end of the day, as a policymaker, I care much less about headline and much more about core. Core is the one that is rising because of underlying demand pressures. Headline is coming because of the exogenous shock. And if we learn anything from the 70s is you don't react to exogenous shocks. You react to demand pressures as well. So unless we're suggesting that the path of increase of commodity prices, the pace of increase in commodity prices is going to continue at the same pace, which I don't think anybody is, then one could argue that the shock that we're seeing is a one-off in nature and will taper off over time. And it's the core that matters. And there are pockets of countries in which core is a problem, but in the vast majority of countries, core is not. And that's why, and that's the one that is function of inflation, of the demand weakness that we continue to see.
Can I mention Bill Dudley's iPad now? So this debate happened last weekend in Queens, of all places. Bill Dudley, the chairman of the New York Fed, was trying to explain why there's no inflation, and he explained, well, you're looking at food and energy, but that's really not part of our measurement. And somebody said, well, what country do you live in where you don't see inflation? And he said, well, to be fair, the new iPad's twice as fast as the old one, still the same price. And somebody screamed out from the back of the room, I can't eat an iPad.